Charitable giving is one of the most rewarding ways to support causes you care about, and it comes with significant tax advantages. When you donate to qualified organizations, you're not only making a positive impact on your community and the world, but you're also eligible for tax deductions that can lower your overall tax bill. Understanding how charitable contributions work from a tax perspective can help you maximize both your generosity and your savings. Let's explore how you can give back while keeping more money in your pocket at tax time. Charitable giving refers to donations of money, goods, or services to qualified nonprofit organizations that benefit the public. There are three main types of charitable contributions you can make. First, cash donations are the most common and straightforward, including checks, credit card payments, and electronic transfers. Second, property donations include vehicles, real estate, clothing, furniture, and even stocks or bonds. Third, while you can volunteer your time and services, it's important to note that the value of your time itself is not tax deductible, though certain expenses related to volunteering may be. Each type of donation has different rules for claiming tax benefits. Charitable giving offers four major tax benefits. First, you receive a tax deduction that reduces your taxable income dollar for dollar, meaning if you donate $1,000, your taxable income decreases by that same amount. Second, this deduction directly lowers your tax bill when you file your return, potentially saving you hundreds or even thousands of dollars. Third, charitable giving can be an effective estate planning tool, helping reduce estate taxes for your beneficiaries. Fourth, and perhaps most importantly, you create a win-win situation where you help others while simultaneously reducing your tax burden. It's a powerful way to align your values with your financial strategy. Not all donations are tax deductible. Only contributions to IRS-approved organizations with 501c3 status qualify for tax benefits. These include 6 main categories: religious organizations such as churches, temples, and mosques, educational institutions like schools, universities, and libraries, medical facilities including hospitals and research centers, charitable organizations such as food banks and homeless shelters, scientific research institutions that advance knowledge and innovation, and arts and culture organizations like museums, theaters, and orchestras. Before making a donation, always verify the organization's status using the IRS tax-exempt organization search tool on their website. This ensures your contribution will be tax deductible. To claim charitable deductions, you need to understand the difference between standard and itemized deductions. The standard deduction is a fixed amount that varies based on your filing status. For single filers, it's $13,850, and for married couples filing jointly, it's $27,700. You don't need any documentation to claim it, and it's quick and simple. Itemized deductions, on the other hand, require you to list each deduction individually, including charitable donations, mortgage interest, and state and local taxes. This requires keeping detailed receipts and records. The key rule is this: you should only itemize if your total deductions exceed your standard deduction amount. Otherwise, taking the standard deduction saves you more money. The IRS limits how much you can deduct based on the type of donation you make. For cash donations, you can deduct up to 60% of your adjusted gross income, or AGI. For property donations like vehicles, real estate, or stocks, the limit is 30% of your AGI. For example, if your AGI is $100,000, you can deduct up to $60,000 in cash donations or $30,000 in property donations. But here's the good news: if your donations exceed these annual limits, you don't lose the benefit. The IRS allows you to carry forward excess donations for up to 5 years, giving you flexibility in claiming your deductions over time. Proper documentation is crucial for claiming charitable deductions. The requirements vary based on donation amount. For donations under $250, you need basic proof such as a bank record or receipt showing the date, amount, and organization name. For donations between $250 and $500, you must obtain written acknowledgement from the charity stating the amount, date, and whether you received any goods or services in return. For donations over $500, you're required to file IRS Form 8283. If you donate property valued over $5,000, you'll also need a qualified appraisal. Remember, always keep all receipts and documentation for at least 3 years after filing your taxes, as the IRS may request them during an audit. There are 4 smart strategies to maximize your charitable tax benefits. First is bunching, where you combine 2 or 3 years' worth of donations into a single tax year to exceed the standard deduction threshold, then take the standard deduction in other years. Second, consider using donor-advised funds, which allow you to contribute a lump sum for an immediate tax deduction, then distribute the funds to charities over time at your convenience. Third, donate appreciated assets like stocks or real estate instead of cash. This strategy gives you double tax savings. You avoid capital gains tax on the appreciation and claim the full market value as a deduction. Fourth, if you're age 70 and a half or older, use the qualified charitable distribution strategy to donate directly from your IRA to charity. This counts toward your required minimum distribution without increasing your taxable income, essentially making it tax-free giving. Avoid these 4 common mistakes when claiming charitable deductions. First, never donate without getting a receipt. You must have written acknowledgement for any donation over $250, or the IRS will disallow your deduction. Second, always verify the organization has valid 501c3 status before donating. Donations to individuals, political campaigns, or non-qualified organizations are not tax deductible. Third, don't overvalue donated items. Use fair market value, which is what someone would pay for the item today, not what you originally paid for it. Overvaluing donations can trigger IRS audits and penalties. Fourth, remember that donations must be completed by December 31st to count for that tax year. A pledge or promise to donate doesn't count. The funds must actually be transferred by year-end. Let's review the key points about charitable giving and tax benefits. First, only donations to qualified 501c3 organizations are eligible for tax deductions, so always verify status before giving. Second, keep detailed records and receipts for all donations, as the IRS requires proper documentation to claim deductions. Third, use smart strategies like bunching multiple years of donations together or donating appreciated assets to maximize your tax savings. Fourth, remember to itemize deductions only if your total deductions exceed your standard deduction amount. Otherwise, you're leaving money on the table. Charitable giving is a powerful way to make a difference in the world while reducing your tax burden. To maximize your benefits and ensure compliance with tax laws, consult with a qualified tax professional who can provide personalized advice based on your specific situation. Start giving strategically today and enjoy both the personal satisfaction and financial rewards of supporting causes you care about.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.